A very good evening, and I warmly welcome everyone. We are truly excited to have you all here as we embark on a journey into the future of banking. Tonight's webinar, Banks, the Next Big Thing, is not just an exploration of the present, but a glimpse into the exciting opportunity that lie ahead. Our distinguished speakers for today's webinar will be Mr. Ranjan Ranatunga, Assistant Vice President, and Zaeema Jihan, Senior Associate Research. And that's not all. Stay tuned for an insightful Q&A session at the end with our Chief Research and Strategy Officer, Mr. Dimantha Mathew. So, Sri Lanka is making significant progress in bouncing back from its severe economic crisis. The recent staff-level agreement with the IMF concluding the initial review in October and the optimistic momentum towards securing the second tranche by end of December, coupled with additional financial support from the World Bank and the Asian Development Bank, underscore the positive path of Sri Lanka's recovery efforts. In light of these developments, our speakers for the evening are ready to guide you through unlocking the next chapter in banking sector, highlighting the attractive opportunities and the top recommendations. So, without further ado, I invite Mr. Ranjan Ranatunga to take us through the presentation. Ranjan, over to you.
Thank you, ladies and gentlemen, for joining on our webinar on the banking sector, which we believe is the next big thing. So, first of all, I'd like to thank everyone who is present here today for taking some time off your valuable time schedules and joining us on learning about the next big thing on the stock market. I'm sure after listening to our thesis that you'll be sure that the banks are the next big thing and you will definitely want a piece of this in the next few months. So without further ado, let's move on to our investment thesis. So our investment thesis rotates around three pillars. One is unlocking of the next chapter in banking, which involves economic growth and that which is expected to trigger the loan book, which will boost profitability of the banks. While on the other side, we have the impairment provisions that are expected to reduce, which will also aid the bottom line growth of the banks. While on the digitalization side, we are seeing that digitalization having a big impact on the cost pressures of the bank while reducing the cost to income ratios and making banks more profitable. So moving on to our first point, which is unlocking the next chapter in banking. So we saw that Sri Lanka was at a very big crisis during last year, and which trickled out. We are still undergoing the crisis period, but we have seen considerable amount of development during the last few months. So with Sri Lanka going into default during last April, Sri Lanka has successfully come out and sign an agreement with the IMF for the staff level agreement on April 2023. And from there, we have seen considerable improvement in terms of our consumer sentiment throughout the last few months. And looking at the future expectations, which is highlighted from the light blue color trend line, shows how the consumer index, expectation index has been performing and expecting a possible positive outcome for the coming few months. So on the back of that, we are expecting GDP to perform better than compared to last year. So if you look at the last year figures, Sri Lankan GDP for 2022 was around 7.8% minus. And during the first two quarters of the year, we saw massive declines in GDP, with GDP growth GDP recording a degrowth of around 11.8 in the first quarter, while we saw some significant improvement coming into the second quarter, which showed where the GDP decline has narrowed down to around 3.1% negative territory. So thinking about that, we are expecting GDP turn positive from second half of this year onwards. And with that in belief, we are expecting the 2023 GDP degrowth to stay somewhere between -3 to 4% for the current year, while in 2024 and 2025, we are expecting GDP growth to pick up and record a CAGR of between 3 to 4% in the next 2 years. So one of the things that that is expected to boost the GDP growth is the reduction in policy rates. So since the time of the publish in this report, which was in October, we have seen one more rate cut during the month of November. And this has been for about 100 basis points. So with that, our expectations for the next 6 months has been pushed forward, and where we were expecting AWDR at around 9% and AWLR at around 10% has been fast forwarded, and this has reduced this has been brought forward with the recent cut in the policy rates by 100 basis points. So with the decline in policy rates, we are expecting the government security yields also to continue its downward trajectory. So last year we saw that the government security yields hitting somewhere around about 25 to 30 levels. But since the IMF finalizing the IMF staff level agreement, and DDO has pushed down rates to around 13 to 15% at current levels. And with the ADR in the coming corner, we are expecting the yields to come down further and hover between 10 to 12.5% in the next 12 months until June. So with that expectation, we are expecting AWPLR also to reduce in line with the expectations. So AWPLR, which is currently hovering around 13 levels, is expected to come down and come down to between 10 to 12% by June 24. Which so this is an interesting chart. So what we have here is how during the last 20 years period, when the AWPLR falls below 15, how the economy has performed in terms of private sector credit growth. So we have seen, so with the bar lines that we are represented here, we are seeing that every time the AWPLR drops below 15%, there's significant pickup in private sector credit growth, boosting the economic growth. So given that AWPLR is somewhere around 13% and expected to come down further to between 10 to 12%, we are expecting a significant pickup in private sector credit growth during the coming months. So with that in mind, what we are having here is a private sector credit growth expectations. So if you look at the past few months, what happened? We saw that when interest rates peaked at around 30% levels, we saw private sector growth contracting continuously for a long time. And since last June, this year June, we have seen private sector growth reverse, with CBS interfering and giving rates cuts totaling to about 650 basis points. So with that, we have seen considerable growth in private sector growth during the last 6 months. So with that in mind, our expectation for this year is that the private sector growth will grow by 1% this year, and by about 7.5% in 2024, and by 10% in 2025. So this is an interesting chart that we have here, which shows what has happened to loan growth during the last 10 years. So loan growth has been very volatile compared to the movement in, and with the sharp movement in AWPR, which has been seen during the past few months. So with that, we have seen loan growth coming down and falling down to negative territory, reversing from an average 10-year growth that we have seen, which is hovers around 13.5 levels. So with that in mind, our expectation that with the pickup in economy that is happening right now, we have seen sizable improvement in the both PMI and service indexes. So this shows that the economy is recovering. And so with that in mind, and with the rates coming down fast, we are expecting the gross loans to grow at about 5% in this year, while picking up fast by about 10% in the next year and reaching the 13.5% 10-year average in 2025. With that, I'm going to hand over the presentation to Zaeema, who is going to take you through how the impairments is going to affect the bottom line of the banks, while from the other side, digitization, how it will reduce the cost pressures of the bank, further aid in the bottom line. So to take you all through the next stage, I will invite Zaeema to take you through the presentation.
Thank you, Ranjan. Let me share my screen first. Hope my screen is visible. So thank you once again, Ranjan. So another aspect of positivity that we expect to reflect on the banking earnings is the reduction in impairment provisioning. So with the economic crisis that emerged last year, many businesses suffered losses, while many had just begun to recover from the repercussions of the COVID-19 pandemic. So following this, NPLs of the banking sector surged drastically especially from the second quarter of 2022, in tandem with the increasing decline in the real GDP growth. So accordingly, by the second quarter of 2023, NPLs of the sector peaked to 13.4%. So with this, banks were compelled to expand their impairment provisioning, not just in the face of increasing NPLs, but also to account for the impact of both domestic and external debt restructuring. But now, with banks being excluded from the domestic debt restructuring and the gradual revival that we're seeing in the economic activities, we believe impairment provisioning has peaked out and will show a deceleration in the period ahead. So as you can see here, from the first quarter of 2022, there has been a steep increase in provisioning broadly across all the listed banks. But it has remained broadly stable in the first and second quarters of 2023. And we believe that this trend will give a sizable support to the bottom line growth of the banks. So moving on, another side of higher provisioning that we have seen has stemmed particularly from the construction and tourism sectors. Construction sector accounts for the second largest outstanding loans as of December 2022, while its stage 3 loans to total loans stands at 16.1%. On the other hand, although outstanding loans of the tourism sector is relatively low, stage 3 loans to total loans of the tourism sector remains one of the highest at 23.4%. However, now that we are starting to see a gradual improvement in payments to the construction sector from the government, we can expect the burden on the banks to tone down. Also, in the period ahead, with the resumption and start of many government-funded projects, construction sector will be the first to benefit. So with that, we can expect a further easing of the stage 3 loans from the construction sector. Then, meanwhile, tourism sector, which is one of the most buoyant sectors currently, with increasing tourist arrivals and the upcoming holiday season, which is expected to bring in more tourists to the country. So with this, we've seen many hotels starting to see a recovery in their businesses. And also adding to that, the 3-year-long moratoriums, which were given to the sector, also has come to an end, thereby lowering the exposure of listed banks to the sector. So with this, the negativity to the impairments and NPL from the sector is largely minimized. So taking these developments into account, we expect that stage 3 non-performing loans to decline from the current peak of 13.4% to 11% by 2025. And in addition to the expected and improved recoveries, broadening of the loan base with the economic revival will also hugely benefit the improvement in the NPL ratio. So next, moving on to our third thesis point, let's see how digitalization within the banking sector and the resumption of business activities will minimize cost pressures. So with the COVID-19 pandemic, people were pushed to use internet for their banking-related transactions. This has been the starting point of a sharp upsurge in internet-based payments. At the beginning of 2020, internet-based payments were only 10% of overall transactions, but now it has escalated to about 50%. So with this sharp uptrend in digitalization, digital transaction volumes and the digital penetration of listed banks has surged considerably high. And this has also pushed LCBs to focus majority of their capex plans in the paths of digitalization. On the other hand, digital wallets, which are also called contactless payment methods, have become very popular, especially among the younger generation, due to its convenience and attractive offers. So currently, Freeme, Solo, Flash, and VPay are some of the most popular Sri Lankan digital wallets. However, this is still very new and has a lot of potential to grow further. And currently, the global market size of digital wallets is at 7.5 trillion and is expected to reach 12.1 trillion by 2026. So these trends have been a huge benefit for banks to overcome their cost pressures, with transactions now being automated and paperless. But as you can see, the banking sector cost to income has declined to 39% in 2022 from 42% in 2021. Another aspect that will impact banks positively is the resumption of business activities. So with the complete relaxation of import bans that is yet to come, and improving and expanding business activities will result in a growth in both export and import volumes. So trade activities, which is simply exports and imports, accounts to the largest portion of net fee and commission income of almost all banks. So this expected revival in export and import volumes will potentially increase the net fee and commission income of banks. The second largest contribution of net fee and income comes from the card-related payments. So as we discussed earlier, the whole digitalization process will benefit banks' profitability also through increasing fee income. So as you can see, fee income has seen a sizable improvement mostly since 2020. While 2023 fee income has already shown a healthy improvement against the first half of 2022. So with that, we expect net fee and commission income to grow at an average CAGR of 6% from 2022 to 2025 across the First Capital Research banking universe, which we believe will aid banks to expand its earning potentials. So next, to take the audience through the valuation aspect of the banking sector, I invite Ranjan once again to take over. Ranjan, over to you.
Thank you, Zaeema. So having looked at the outlook of the banks and how the key catalysts that are moving the needle for the bank in terms of bottom line, we'll be looking at the valuations next. So banks have traded at a massive discount. It's currently trading at a massive discount as well. That this has mainly been affected due to the defaulting of Sri Lanka on the outstanding loans, as well as the major contraction in economy that we saw during the last year, as well as the first half of this year, which has brought down profitability of the banks. So with this in mind, what we are saying now is that the banks which are trading at one of the lowest multiples currently is expected to benefit and is not justified at the current trade. So coming on to domestic debt optimization. So one of the key things, as I highlighted, was that the Sri Lanka went to default and we had to negotiate our debt to make it more sustainable. So part of that was domestic debt optimization. We saw that the government successfully completed domestic debt optimization in the month of September. And with very positive news that the bank's holdings of bonds as well as SLDBs were not subjected to haircut and was only subjected to maturity extension. And so this is a very positive development for banks. And since September, we have still not seen the share prices being reflected positively with the finalization of domestic debt optimization. Also, we have seen continuous improvement in major economic indicators. So if you look at the left-hand top chart, we have the gross official reserves of Sri Lanka. So we have, during the month of September, Sri Lanka reported gross official reserves of 3.5 billion. And our CR expectation for the full complete year this year is 4.5 billion. Looking at the numbers, it may look a bit tough, but with the EDR in the coming corner, EDR finalization in the coming month, as well as the guarantees that were given by the World Bank and ADB for totaling to more than 600 million USD have also, we believe those are the catalysts to bring the reserve percent to 4.5 billion to end the year with. And moving on, we had the CCPI chart. So last year during September, we saw CCPI peaking at around 70%. But now, as to the positive, this has significantly improved and currently holding around 1.3% during the month of October. Then looking at AWPR, which was around 30% level, has come down to around 13% levels. So which is expected to boost economic activity in the coming quarters. So with the decline in AWPR, we have seen private sector credit growth has also improved and showed growth for the first time in 12 months in the month of June. And since June, this has continued to grow for the last 6 months. And with the currency remaining very stable at around 330, we have seen a strengthened position in terms of balance of payment position as well, with remittances and tourism performing very well above our expectations. And so something to note is that the credit upgrades that happened. So with the completion of DDO, we saw that both all three agencies, including Fitch, SP, S&P, and Moody's, revising up our local currency ratings with the completion of DDO. But now with the near completion and the finalization of the second tranche of the IMF agreement, which will be possibly happening in the month of December, we may see foreign currency rating upgrades happening as well. So these are big positives for the banks in the coming months. So looking at the valuation of the banks, as I told you before, banks has been trading around 0.5 to 0.4 times. The bigger banks trading about 0.5 times, while the smaller banks trading at about 0.4 times. So these were mainly because of the factors that I highlighted before, which took a toll on the valuations of the banks. And if you look at the past 10 years, this is pre-COVID, we have seen that banks have been normally averagely trading about 1 times book value. And we believe that there is potential for the banks to revise up and trade at 1 times in the coming months as well. And if you look at the regional peers, Sri Lanka banking sector, as I told you, is trading at about 0.5 times now. And if you look at the Vietnam, it's trading at about 1.2 times book value, while Bangladesh trades at 1.1 times book value, while the Thailand and Pakistan trades at 0.9 and 0.8 times, making Sri Lanka the cheapest shares in terms of banking sector shares compared to the regional peers. So one of the things that we are considering because of the banks performing very well above expectations and reach 1 times book value is the profitability. So last year, we saw that because of the massive impairments that Zaeema spoke about before, banks' profitability came down by 23%. But with solid recovery being shown during the second half of this year, we are positive that the banks will grow at about 4% year over year in terms of net earnings for the current year. While this will be further accelerated to double-digit growth and reach 16% and 20% in 2024 and 2025, which will also push up the ROEs to double-digit levels to record 10% in 2024 and 11% in 2025. So this slide here highlights where the banking sector currently is hovering around. So if you look at the PER, the banks currently trade about 4.7 times PER, while the Sri Lankan CSE trades at about 12 times. While in terms of PBV, banks trade at 0.5 times, while the CSE trades at 1 times. So there's a lot of opportunity in the banking space for grabs right now. And here we have a small snapshot of the FCR banks valuation, banking sector valuations, where we have valued the bigger players, the commercial, HNB, Sampath, as well as NTB at 1 times book value, and almost offering near 100% or over 100% returns in terms of the current share price. While the smaller banks, the Ceylon Bank and the NDB is valued at 0.8 times and also offers more than 100% upside for the current share price. So in here, we have the weekly the valuation guide snapshot of the banks in the banking sector and its trading multiples that are currently there. So with that, what we have discussed so far has been the outlook and the key catalysts for banking sector and the valuation of the banking sector. So with keeping this in mind, we will look at the key risks that the banking sector will face in the coming 12 months, which you have to take into consideration when putting your investments in banks. First, we have the capital adequacy buffers. So we saw that because of the high NPLs that was there last year, most of the banks had massive provisioning for NPLs, and these brought down the profitability of the banks. And so with this, the banks are currently almost at a near threshold in terms of capitalization. So with this in mind, there can be debenture issues in the coming months as well. And we have already seen banks such as NDB, Commercial, Sampath, and others already announcing debentures. But with the conversations we had with the banks during the last month, we have got to know that the banks may not opt for a right issue right now, mainly because of its poor valuations right now. So there's no potential upside for banks to come down and further give a discount to make the right issues more attractive. So debentures are in cards, but right issues are not. So this is something to be noteful in the coming 12 months. In this slide, we have here is the capital adequacy buffers that are currently on the banking system, with the dotted lines highlighting where the threshold is. And while we are seeing that most of the banks are hovering near the threshold limit, which will cause banks to offer debentures, as I spoke in the slide before. Then the elections are there. So as everyone here knows and understands, the elections raises a big risk for the banks as well as the economy. So we have seen that with the past regimes, there are a lot of election favors that was done, and this resulted in towards the macro as well as the banking sector stability. So this is a big concern, but something to ponder is the silver lining in it. We are under IMF right now, and IMF has kept tight leash with us, with keeping us with strict reforms and targets that we need to achieve in order to continue with the IMF agreement. So with IMF keeping tight Sri Lankan tight leash, we believe that the risk of elections that are coming up will be slightly mitigated. And so with that, we are finishing up with the presentation. And thank you for joining. And we believe that as the FCR believes, you all also have understood why we believe that banks are the next big thing in the stock market, and which should offer you and give you can also double your returns in the next 12 months. So with that, I'm handing over the presentation to Tarusha to continue with the Q&A session.
Thank you, Ranjan and Zaeema, for a precise and insightful presentation. Now we are moving on to Q&A session, and to join us for the Q&A, we have our speakers for the evening, along with Mr. Dimantha Mathew, our Chief Research and Strategy Officer. So we will give our audience 5 minutes to type in your questions in the Q&A tab below, and your questions will be taken up thereafter.
Thanks a lot, Tarusha. So let's go into some of the questions that we have already got. Starting off, I think there's a question on what is the impact of the budget 2024 to the banking sector. Let me give it a try. So I think there was no major hit from the budget to the banking sector. But what we've seen is that basically there was a 450 billion recapitalization that was basically set aside in the budget, and that is mainly targeted at the state banks. So other than that, we did not see any other major hit or any type of relationship to the banks. Also, something else that might be interesting is that there was a number of construction related projects that was sort of being proposed. So that is one thing that probably would be beneficial for the banking sector, where if the construction sector does revive, there could be some of the NPLs that could get paid off and sort of reversed. So those are the things that I could think of. Ranjan, is there anything else that you would want to add in?
I think Dimantha, you covered everything.
Okay. So then let's go into the next question. So with the agreement of the OCC for debt treatment, what is the impact on ISB holdings of banks? Ranjan, you want to give it a try?
Yeah, sure. Yeah, so we saw yesterday that the creditors, the creditor committee of Paris Club agreeing and sending us the draft proposal for the debt restructuring. So with that, what will happen is that we will after finalizing and signing an MOU with the Paris Club, we will receive the full details of the debt restructuring proposal, and from there onwards, we will move on to discuss with the ISB holders as well as the private creditors on how to restructure a debt in line with the proposal that have been submitted by the Exim Bank and as well as the Paris Club agreement. So we will be the government of Sri Lanka will be approaching the ISB holders as well as private creditors, which represented by around USD 274 million, and through a few countries like Pakistan, Kuwait, and UAE. So these countries will be approached, and with debt sustainability targets will be discussed and in line with the proposed agreements that are proposed by the Paris Club and as well as the Chinese Exim Bank.
Thanks, Ranjan. Also, there's a sort of question on loan growth. What is your expectation on private sector loan growth? We, I think, answered that, but I think, Zaeema, you want to take it up and probably remind investors as to our expectations?
Yeah, sure, Dimantha. So at First Capital, we are believing that for the 2023 year, we'll see only a marginal improvement in the loan growth of probably 1%. But in 2024, we are expecting to see a private sector credit growth of 7.5% and 10% in 2025. So to support this, by now, for the 5th consecutive month, we've seen an improvement in the loan growth. Private sector credit growth. Even in the month of October, we have seen private sector loan growth being increased. Private sector loan has increased by 38 billion. And another factor to consider is the aggressive policy rate cuts that we've seen over 550 basis points. These two will also support the private sector loan growth. Yeah.
Thanks a lot, Zaeema. So from our investors, we have another question. Can you comment a bit about NBFI sector, especially in relation to the listed bank subsidiary NBFIs? Yeah, so I think we can give a comment on NBFIs overall, probably bank subsidiaries. I think probably they are referring to from subsidiaries of the overall, like Siapata Finance and HNB Finance, I think. Ranjan, you want to take it up, an overall comment from the banking sector? Sorry, NBFI sector?
Yeah, Dimantha. So what we are seeing so far in terms of results on the NBFI sector has been that we have seen improvement in profitability. So partly that is coming from the activity that we have seen in the leasing business, that is coming from mainly from the leasing of machinery that is used for agriculture and industrial purposes. So the growth that we are seeing that are in the books in the NBF sites are coming from there so far. And also, we have seen in line with the banking sector performance, impairments has also been coming down in the NBFI sector. So together with this combined, that the NBFIs have been performing and growing at a steady rate and has improved their profitability compared to how it was before during last year as well as first half of this year. And so something notice that the NBFs are performing well compared, taking into consideration the import ban on vehicles that are there currently. So we at First Capital are thinking that the import ban will be lifted by next year, mainly because that the government needs taxes or the custom duties that are coming from vehicle imports. So with that in mind, we may see vehicle import ban being lifted by next year, but somehow it will, but in other terms, it will come at a cost, mainly with the taxes. We believe that the government, in order to curtail the pent-up demand on the vehicle market that have been that is there currently, to curtail that, we may see taxes being raised, and but something positive is that the leasing business will come back online. And this is something positive on the NBO side to see going forward. And again, impairments will also continue to come down with the recoveries we are seeing in the key segments of the economy. So it's going to be positive and be positive, and it will go hand in hand with the banking sector and will perform very well in the coming months.
Yeah, absolutely, Ranjan. So definitely under IMF program, you cannot have import restrictions, but yes, this is a special case. However, there could be, so definitely import restrictions, especially on vehicles, is likely to get lifted with possibly a tax rise as well. So that's a summary there. So we have a question on the valuations, what we've used as valuations. Zaeema, do you want to take this question up? What type of valuations we've used to come up with the fair value for the banking sector?
Sure, Dimantha. So we've primarily used PE-based valuation, PBV, and also residual valuation in our fair value.
Yeah. So basically, three valuation methods: PE, PBV, and the residual income method. So three valuation methods and equal weightage on the three. Yeah. So a question on the dividends. The regulator has still put a freeze on dividends. When will that be lifted? So let me take that up. The dividend, the freeze on dividends was there until last year, right? And after that, beyond 31st December 22, it was not extended. So afterwards, I think we first saw the dividends for Sampath Bank coming in early part of this year. So dividends has been declared during this year, and that freeze is actually no longer there. So you can request, or obviously the regulator has to give approval to provide dividends, but that has been the normal trend. So, and dividend has been given on a continuous basis, but something important to highlight is the fact that I think dividends has been in the form of scrip dividend for most companies, because simply because that they wanted to preserve cash and build their capital buffers. You can see even what Ranjan presented, in some of the companies or the banks, capital buffers were trimmed. Obviously, with NPL slightly moving down, and that is likely to get readjusted and allow them to go for more growth in terms of loans. But currently, we are seeing a bit of a trim buffer on the capital adequacy that they have at the moment. There's a question on any potential mergers next year. Ranjan, you want to take that up?
Yeah. So talking about that point from a perspective of capital requirement. So far we are seeing, as we presented, many companies are near the capital thresholds, and we have seen during the past also that the government's pushing for the consolidation on the banking sector, with belief that there are too many banks are there, and there are a lot of small banks. So we have heard stories that there has been proposals that for consolidation in the banking sector in the past, but post-COVID, we have not heard of any developments in terms of consolidation in the banking sector, anything recently. Dimantha, you have anything else to comment on this?
Not really, not really. So on the merger side, we've not really heard anything, so it's nobody has really announced anything as well. So how there's another question on Pan Asia Bank share. We've not really covered within this, but possibly we can give a brief answer on that, I guess. How will Pan Asia Bank perform in the next 12 months? So overall, I think we are very positive on the banking sector, and as a sector, we think there's a lot of potential in the sector. Valuations are very good, the story is good, the economy is recovering. So all that is there, and as a small bank, EBC is obviously likely to perform. Ranjan, you want to add anything specific? Is there anything specific that can be added there?
No, not really. I think covered it.
Okay, okay. Right. Yeah, what is your interest rate expectation for first half 2024? Will policy rates come down further? So let me take that up. In terms of policy rates, we don't think it will come down further. So the last policy rate was probably what we thought one policy meeting ahead. We were expecting the rate cut in January, but it was given in December. But all in all, the policy rates, we believe, has sort of bottomed out. And if you read along the lines in the policy outlook that the central bank has put out, the announcement also says that they are likely to take a pause. So in line with our view, the rates are likely to stay in the range of 9 to 10% for the current period. However, interest rates, we think, further has room to drop, simply because policy rate, the interest rates are really not reacting to any sort of policy rate cuts at the moment. So what it does react to is the debt restructuring. So we've had the DTR, the domestic debt restructuring, where overnight we saw interest rates falling by 10%. Now we are looking at the EDR, which is the external debt restructuring. With that, we believe there is a possibility that interest rates are likely to drop significantly. So we are targeting as a December 11 to 12% for the 1 year for the rates to fall, and the 5-year and 10-year also around the range of 12 to 13%. So overall, we think rates are likely to drop, and obviously with the news even yesterday, we saw some reaction yesterday itself in the market, but after the actual debt announcement or the restructuring announcement coming in with Sri Lanka moving into debt sustainability and Sri Lanka managing to obtain the second tranche of the IMF, all these factors will is likely to push rates down significantly within the overall yield curve. There is a chance that the overall yield curve may come below the 12% mark. Obviously, the quarter of yeah. So what are the other sectors that will shine in 2024 apart from banks? Are banks the only next big thing? Ranjan, you want to give an answer to that?
Yeah. So to start off with, why we are highlighting the banks as the next big thing is the massive discount the banks are offering right now in terms of valuations and the future outlook. Apart from the banks, we also have the NBFCI, which will also perform very well in the future, together with the consumer segment. While we may see the heavyweights such as diversified companies also picking up because they are exposed to the star segments in the economy, including the tourism. Yes, I forgot to mention about the tourism. Tourism is also amongst one of our key picks for the next year. So again, coming back to diversified companies, given that these are exposed to very all the star segments in the economy that are expected to perform very well in the coming months, we believe that these will also move in well in the coming months as well. And we have been sharing the recommendations every week as well, and there carries a list of our top recommendations for if for your interest as well, if it's needed.
Yes. Thanks, Ranjan. There's a question on the VAT increase and its impact on the loan book in 2024. I would like to put it to Zaeema. Zaeema, you want to give an answer to that? Do you think that the VAT increase could have some impact to the loan book?
Actually, Dimantha, there's not going to be a huge impact per se, because with the decline in the interest rates, there's going to be a upside to the loan book rather than a negative impact. If there is an impact, we would see a very marginal decline in the loan book, but mostly it's going to be close to nothing.
Right. Great. Thanks. So basically, the decline in interest rates is likely to outweigh the increase in VAT, is the answer. Yeah, FCR forecasted the ASPI to surpass 12,000 by December 2023. Does FCR still believe this is possible? Yes, I think we still believe this is possible. So I think the index peaked at 11,700 in the month of September. and beyond that, so very close to the 12,000 mark, but the trend didn't continue with the weak earnings and also the delay in the IMF or the second tranche of the IMF because there was some delays in the negotiation process of the external debt restructuring. However, we are now seeing progress there, and possibly on the 6th of December, we're likely to get the board approval for the from the IMF for the first review or the second tranche as well. So, in such a situation, we think that will significantly affect interest rates positively, and then with lower interest rates, obviously there's going to be a significant demand for equity investments. So that is likely to benefit equity investors. So yes, we think it's a matter of time for the second tranche to be finalized and rates to drop. So if that happens, 12,000 is still on the cards. Beyond that, I think we should still look at an upside in the market because rates we believe that are going to further decline in the first quarter, and there could be a bit of a bull run in the market with such lower rates. That's what we've seen in the past. We've seen that a couple of years ago as well when interest rates dropped to 6-7%. So highly likely that there's there could be a sharp run or a bull run in the market over the next couple of months. Next, shall we go into there is a question on what would be the impact of the day one losses for banks from the foreign debt restructuring. Oh yeah, I think basically we've discussed this when we met the banks. Ranjan, you want to take that question up? It's
Yes.
regarding the day one loss when the debt restructuring is happening.
Yeah, so based on the conversation that we have with banks, so with DDO, we saw that the SLDBs and the bonds were excluded from restructuring. And so with that, the unused SLDB provisioning that we saw that was done by the banks have been moved to bump up the ISB provisioning. So with that, we have seen that most of the banks are getting ready for a hit if that comes through for a ISB haircut. And we have seen the banks has increased their provisioning up to around 50% to take the hit of the in case if there's a hit on the from a haircut together with the day one loss that is coming to the for the new bonds. So in that case, there won't be any future profitability impacts to the bottom line because we believe that the banks have done enough provisioning to take the hit in terms of the haircut as well as a day one loss if in a case where there is a haircut on the ISB provisioning. So in terms of that, there is nothing to be worried any further because if you look at the statements also that have been coming out from the banks during the last this quarter as well as a bit on the last quarter, we have seen that provisioning in terms of impairments has been coming down continuously. So that is also a signal that the banks have done with the impairment provisioning for ISBs as well. So, and the banks are confident that ISB provisioning as well as a day one loss will be within the 50% range. So there is nothing to be worried in terms of a day one loss or a haircut on ISBs that would further impact the profitability of the banks in the coming months. Anything to add on that, Dimantha?
Yes, yes. So the just to summarize on that, we with after we had a chat with the banks is that there will not be a uh, further provisioning as they've already bumped up the provisioning to close to 50%, and on some banks or 50%, already taking into consideration this day one loss of the new bonds that are likely to get issued. So in the forex restructuring, the current bonds may be replaced by new bonds, and those new bonds could have a day one loss. And so in order to cover that, the banks have already bumped up their provisioning. So something related to that, Ranjan, there's another question. So I'll put it to you as well. Which CBs are most exposed to ISBs, which will be subject to EDR? Yeah, which banks have the highest number of ISBs?
Yes. In terms of exposure levels, we are seeing the top three, the big players, the commercial, HNB, and Sampath, are amongst the highly exposed in terms of ISB provision, ISBs. In terms of the government securities, they are holding in ISB securities. So these three are the biggest players who are exposed to ISBs.
Okay. Okay. So there is a further question on private sector credit growth. I think we answered that initially. So we'll go to some of the other questions. How do you see policy, market policy behaving in 2024? I think will it be further cut in bias? So I think we already answered this question. So we don't think there'll be further rates cuts, and within the things would have would bottom out here. 9 to 10% we think is the bottom, and beyond that, within the interest rates will drop and the economy will revive beyond this point. Which bank has the capital ratio headroom to grow most in terms of loan? All right, okay. So which banks have basically the higher buffers to grow their lending portfolio is what's being asked, Ranjan. So you want to answer that?
Yeah. So in terms of the capacity to lend, we have seen that all across the banks are looking to lend right now, and they have the necessary money is also to lend out. And the issue that has been there during the last year, during the last couple of months, even when the rates are coming down, is that the people are thinking that rates are too high to go for a loan right now. But now we have seen the rates have been coming down and it's below 15%. And and also something notice that the banks are not aggressively going behind loans during the last year, because the government securities are offering much more better yields. So if you look at the yields that were there in the government security, so government securities had yields around 30% levels. So that was a massive gain for the banks instead of lending, which is a riskier business at that point of time. So banks are also on a conservative basis to lend. But we are seeing that right now changing. We are seeing that the rates have come down below 13, it's hovering around 13% level, while in terms of the banking side also, banks are willing to lend. We are seeing the calls that are getting back to us again regarding loans. Now the banks are asking whether we want loans or not, and they're offering reasonable price points as well, such as a housing loan is offered at about 12% range. So they are taking necessary measures, and the banks have the necessary monies also to do lending right now. And so yes, that's it.
Yeah, so let me add a bit onto that. Yes, so most banks do not have a problem of lending. So when we say lending, we don't think there's going to be aggressive lending, right? According to the economy, it's going to be more or less like slow lending growth. So that the banks do have capacity, or almost all the banks do have capacity, because we have to understand that the economy is growing at 3 to 4%, and in such a situation, you'll only have credit growth in the range of possibly 7-8%, but obviously next year there could be a bit of a pent-up demand, so they could go up to around 10%. But then overall, when there is low economic growth, lending growth is also sort of limited. But if you want to know a couple of banks that possibly have higher room to grow their loan book than possibly the other banks, possibly we could name probably, I think Nations Trust Bank has a lot of room. Then I think Sampath Bank also has room to grow their book. I think those two are the ones that I think have more room than the others, I guess. Want to add anything there, Ranjan? Or?
Yes. So what we have been hearing from the banks is that also that they are looking at lending right now, and they have identified few sectors such as export and import businesses, and also tourism as potential lending targets. So, and if you look at NTB, they are going in a strategy where they are targeting a certain segment of the economy to lend, such as like this. The banks are taking different strategies to lend going forward. So based on these also, it will based on these and how the growth on these segments will also result in the loan book growth and the capacity that the banks can achieve the targeted expected loan book performance as well in the coming months. So these are a few things to note when considering the potential of the bank's lending capacities.
Yes. Yeah, so there's another question on if you look at the 15% credit growth rule, this I think is referring to the line we've drawn. I think the 15% rate line. I think how does that graph look like with real interest rates put on it? Currently, real borrowing costs are very high as inflation is very low. I don't think we've really looked at it from that angle in terms of real interest rates, because what we just saw is when rates do fall below 15%, obviously there's a bit of a lag effect. But when rates do fall below 15%, we are seeing some amount of lending coming into the picture. Obviously, it's very clear that above 15%, it's going to be difficult for people to borrow and survive with the funding cost that is there. So below 15% is where there's a comfortable repayment amount that is there to match the income levels that are there currently. So I'm sorry, I don't think we can clearly answer your question without really looking at it and drawing the charts, I think. Okay. when Sri Lanka banks are going to adopt Basel IV? That's a bit of a tough question. Do you want to take that up, Ranjan? Basel IV, I feel that it's a bit away at the moment. More room for that. What do you think?
Yeah, I also agree with you, Dimantha. So, given that Sri Lanka went into Basel III about few years back, and we are now only seeing the banks almost like with the performance that happened during last year, the negative performance, we have seen the thresholds has been trimmed down, as we have spoke before. So, in an event like this, adapting a Basel IV would also put more pressure on the banks. So, and there has not been, as of my knowledge, there has not been much talk regarding Basel IV implementation in Sri Lanka. So I think it's a few years away, right, Dimantha? I think from it.
Yes, I also think so, because we are just coming out of a economic crisis. So it's going to be a bit difficult to implement Basel IV immediately, because there'll be a lot more stringent measures and higher capital structures that obviously need to be maintained. So it's going to be quite difficult to implement it immediately. On the next question is on the deposit raising side, which bank is the most bullish for 2024? Your strategy is contingent on there being loan growth. Which bank is most bullish for 2024? At the moment, of course, almost all the banks are offering the same rates, I think around 9.5% for FDs. Yeah, I think it's probably you could answer that, Ranjan, in the light of possibly which of the banks probably would look at growing loans faster. I think the question is something related to that. The raising funding in line with the loan growth, I think.
Yeah, and also Dimantha, something I think the question also raises the side of the deposit side. So
Yes.
commenting a bit on it, so we saw that during last year and the previous year that in the last year as well as the first half of this year, with rates almost at around record high levels, we saw banks CASA mix fall into below 30% levels. So now what the banks are currently eyeing is increasing its CASA mix, so that the cost of funding of the bank's components come down, because normally in a downward interest rate regime, the the margins of the banks getting shrinks. So to negate that off, the banks are targeting to increase the CASA mix. So the bank's profitability and the margins or the NIMs will return back to somewhat of a normal level. So from the conversations that we had with the banks, that most of the banks are targeting CASA to go around 32, 33 levels and reach somewhere around 35% by next year, to help them with the bottom line improvement. So yeah, I think I partly managed to answer the question that we are given in terms of loan book growth. Yeah. So yeah, I think the banks are in a comfortable position to given with the slower first half of the year, they are moving on with the business as usual, but loan book growth has been a bit on the downside during the last 2-3 months, mainly because the slowness in the economic pickup activity levels. But moving forward into the next 2 years, we believe that with the economy picking up, loans will also get triggered. And as Dimantha explained, with a GDP growth of between around 3 to 4% levels, the best case scenario for loan book, I think, is as as explained, is around between, I would say, a bit around the 12 to 13.5 levels, the 10% CAG average that they saw in the last 10 years.
Yeah. So that's correct. So they will be looking at more CASA for this year with the or next year with the declining interest rates to safeguard their margins is the answer. Yeah, so something closer to the deposit side. Let me put this question to Zaeema. I think so. Zaeema, there's this question on deposits and government securities. So, with Treasury performing so well, is there a risk of banks losing depositors to the government? So the question is basically whether depositors, rather than going to banks, would they actually choose government securities instead?
Yeah, Dimantha. So I think choosing government securities is also an attractive option at the moment, given that the deposit rates are relatively low. Yeah, do you have anything to add to it, Dimantha?
Yeah, so basically, I think you're correct. I think there are a lot of investors that are switching to government securities at the current period. But I think the popularity of the government securities or knowledge of investors about government securities. I mean, even First Capital does offer government securities, but you don't see depositors rushing in compared to government securities. Yes, there is a slow trend, but I would say there is a lot more knowledge that needs to be given to investors. Financial literacy needs to get improved. I think there's lot less knowledge among investors about government securities. So I think the easiest and the most comfortable at the moment for depositors is still the going to banks and putting FD. So I think though government securities is a AAA instrument, investors are still comfortable with banks, and that's probably one of the really naturally sees that when the risk of government securities, once that is taken out with the EDR also coming in, this once the debt sustainability is stabilized and maintained, you will see the yields of government securities also dropping significantly. And then you will see the rates actually being similar to, historically we've seen bank rates slightly more or less similar to government securities rates. So that's what you would see going forward. Right. Regarding Pan Asia Bank, I think we answered that question. Let's go into a another question in terms of share ownership, which bank has the most likelihood of sharp increases due to limited free float? NTB's major shareholders still hold most of that company. Yeah. Ranjan, you want to take this up? Share ownership.
Yeah. Yes. I think the question
It's regarding the free float, I think. Yeah.
Yeah. So I think the question correctly states that NTB, the major shareholder John Keels, is holding a majority of the share, and there has been earlier, and so there has been talks of JKH divesting part of their share to bring in compliance with the banking regulations. So, but we have seen that JKH has not been actively pursuing that idea during, and they have gotten the necessary approvals also to defer it a bit longer. But in terms of the share ownership, I would say yes, NTB, we saw a massive increase. That was mainly coming due to their conservative approach in terms of government security holdings in a case where DDO was in concern. And we saw a steep appreciation of the share because of that. And the profit and the lower impairments because of the carefully targeted groups. But something to mind is that right now the banks are trading at 0.4 and 0.5 times. So there is a lot of room to go up in terms of share value. So yes, free float is something to note, but I believe that the entire banking sector is operating at such a discount that most of like any of the banks that are in the sector would appreciate and perform really well in the coming months with the economy picking up and the factors that we have highlighted before. So just keep an open mind on the banking sector. I believe that there's a lot of money to be earned in the banking sector, and there's a lot of possibilities where an investment can be doubled in with an investment in a banking sector share.
Yeah.
Dimantha, we can move to the next one.
Yes. Sorry, I got a connection issue. Yeah, I think we've answered a lot of questions. Let me take one last question before we close. There's one question about the money market fund with the policy rates being brought down. What is the impact on the money market fund? Is there an anticipated rate the money market fund will get stabilized? So what you see is with the gradual decline in interest rates, obviously with a significant lag, money market fund rates also are likely to come down, but obviously there is about a 3 to 6 month lag because depending on the investments that the fund managers have done. Of course, the actively managed money market funds, of course, will have a delay in yields coming down. However, if possibly rates stabilize around the 10 to 11% or 10 to 12% mark after about 6 to 8 month period, you can expect money market rates to gradually come to that level. But it obviously it will take a bit of time depending on the investments that they have already made. Yeah, so I think there's a lot more questions that are there, but I think we've run out of time. We've taken about 1.5 hours in this presentation. So with that, I would like to hand over proceedings back to Tarusha to for a closing note.
Yes, as we bring this Q&A session to a close, we extend our gratitude to Dimantha, Ranjan, and Zaeema for their invaluable insights. We trust that today's discussion has provided clarity on various aspects of the banking sector, addressing any uncertainties you may have had. Thank you all for being a part of this discussion. As we conclude, we wish you a great day ahead and stay tuned for more engaging discussions in the future. Thank you.